Hi, everyone. My name is Caroline Adler. I graduated last May from Loyola. I was an accounting major and a Spanish minor. So I currently work for PwC, technically out of the DC office. I'll actually be moving this Friday. So I've been living at home since we were the end of the semester last March. So I'm excited to be here with all of you today. And I was in your shoes like not long ago. So hopefully some of the things I can share will be helpful.
And I'm JP Krahel. I'm an accounting professor here. I'm also the department chair for the moment. It's good stuff. And I was in your shoes, yes, long ago, but still I remember enough that I can hopefully still be helpful and kind of give you more the technical side of things, and Caroline can give you the human side. But Caroline, I want to start out because you had mentioned, one of the intimidating things about kind of starting off is kind of the financial concerns and the idea of handling paychecks and saving money and living at home. And what have you found to be the benefits there?
Yeah, definitely. So I guess you could say like this was definitely a pro of like the unprecedented times. I didn't really expect to be coming home last March and then stay like being home for basically over a year. I would have thought I would have moved out kind of right away after college. Like I knew what I was going to be doing right after I graduated. So I did intend to kind of have to start thinking about like finances right away and budgeting and kind of keeping that at the forefront of my mind. But obviously, given the circumstances, I did end up just staying home for the year. And I think really what a great benefit of that was kind of having a cushion so that now once I'm moving, I have kind of created more of a like forced savings for myself. So there's definitely less of like a pressing, like obviously still budgeting is still extremely important and something I already plan to, I don't know, focus a lot on. But I've already built up kind of a strong cushion so that once I do enter living on my own, it will definitely help a lot.
I think one of the things to remember is there's a concept we talk about in accounting, and Caroline will know about this, and I think some of our visitors will as well. There's a concept called the time value of money, which essentially says, and there's math behind it, but a dollar today is worth more than a dollar tomorrow. And that can work in your favor in that if you start saving now, it'll start accumulating interest more quickly. But it can also work against you in that if you have things like debts or things you're trying to save up for, um, interest can work against you as well. So like if you're paying off the minimum on your credit card, but there's a lot that you have left to pay off, interest is going to start accumulating on that. So when Caroline talks about building a cushion, it's not just for like the thing that you like. Instead, it's really so that when you do step out on your own, you're going to have some muscle and some like weight behind you, so to speak, that you'll be generally well prepared. Um, if anybody has any questions that you're comfortable asking, on the record, this is for you. So please, if you want a private chat or something, we can talk about it that way too. But um, another question about budgeting and the whole kind of human side of it. I know something else Carolyn and I had to talk about. How do you handle bills? And what are some of the pitfalls that you probably didn't expect to need to handle before you got out kind of at least semi on your own?
Yeah, so that's a good question. And I guess Dr. Krahel and I were talking about this last week, but just like the importance of finding a system that works for you, just because everyone is different and everyone finds that they organize themselves in different ways. So it's important to know that not what your friend might do or your sibling might do might differ from what works best for you. So at least what I'm planning on doing, just because I know like things can get caught up in the mix, and as you graduate and as you move on to the real world, there are a lot more things that you like have to think about and have to keep organized, just so that everything like nothing falls through the cracks just because there are a lot more like responsibilities once you're on your own. So at least something that I plan to like implement, especially as I do start to live on my own, is a website called Mint. It's basically like a personal budgeting system. It's free, so you don't need to. Basically, all you do is log in for the first time. You set up a username, password, and it's extremely secure. So like what you're able to do is you can link all like any bank accounts you have. You can link them directly into your system, into your account. So you can see everything like all in one screen. Like you can't pay your credit card bills or anything on there. Like you'll have to go into your separate like banking website to do that. But at least it's a place where everything that you need to see is in one place. So I think that's going to really help me just be able to visualize everything. And you can even set reminders when like bills are due. So you can go in there and see if you have rent or that you need to pay, or if you have credit card bills you need to pay, you can see all of that on your overview screen. And there's like a budgeting function as well. So you can kind of estimate like what expenses you're going to have. You can set different categories and you're able to like estimate what you think you might spend per month. And you can just kind of setting that for yourself in advance. Like nothing needs to be perfect, but at least it's a good way to start. And then you can kind of gauge where you're at and reevaluate like if you need to change anything.
So your finances stay in mint condition. Sorry. Okay. But one trick that I've noticed as well, at least it works for me, you can usually choose a due date for, either rent or credit card payments or something. I like to have them at the first of the month. So this way I know if I make it past the first, I'm okay for the rest of the month pretty much. It's just little mnemonics for things that you might not have had to worry about up until now. I don't want to say it's almost like cheating though. In other words, if you stack the deck in your favor to make sure that you're making payments on time, it's going to help. Again, let me pause. Does anybody have any specific questions about budgeting or concerns or timing or anything like that? Monitoring chat, not seeing anything. That's okay.
Could we just jump in? I don't know if you're going to get here in a little bit, but as we think about that budgeting and what you're saving, any general guidelines in terms of the percentages that you would recommend or anything like that, so that we could, but not necessarily real numbers to it, but give students a sense of the actual strategy behind that?
I can tell you from my perspective, I get asked that question of like, how much should I be saving, either as a percentage or as a dollar amount? I never saw it that way because money is a tool that's meant to be used for something. So it really depends kind of on what your goals are. Obviously, generally speaking, more saved is better as long as you don't starve to death, right? But it really depends on what you're saving for. And it's, do you just want to have an emergency fund of, a couple $1,000s, or are you looking to maybe put a down payment on a house in 3-4 years? Once you know your end goal, then you can start walking toward it in terms of how much to be saving. And honestly, if you figure out with your budget that a goal is either impossible or easier to achieve than you wanted, then you can readjust. But saving for saving's sake, beyond just having that cushion, do something, like plan for a home, for a car, for moving out, for saying, okay, now I'll have 6 months rent saved up. So in the case of something bad, I know I'm at least not going to be forced out right away. I think you start with a goal and then say, okay, how do I make that happen?
Yeah, that's a really good point. And to go off of that, like with the goal and like the forefront, Mint actually does have a category that allows you to set a goal. So, and it even like has like pre-recommended ideas. So like you could save for like a rainy day. So like, you don't know, like kind of just like an emergency fund, like plan for like a vacation, plan for a house payment, like JP said, like, so, and then you can even like customize. So if you have something in mind that you don't see on there, like it kind of just gives you like a step-by-step walking through like what you need to put away and like just different ideas on how you can reach that goal with your budgeting.
Thank you for the question, Jim. This is good.
Sure thing.
Let me ask something else, Caroline. When you got your first job, you were eligible for a lot of benefits, and I think a lot of students look only at salary, and they'll use that to compare, or even if they may just not know what they're eligible for. So can you talk about like some of the benefits, large and small, that you were eligible for, and kind of the language behind them and what people should be looking out for?
Yeah. So we'll probably go into this a little bit more in a little bit also, but I'll touch on it now. So if your like employer offers a 401k like pension plan, I would definitely recommend, like, it's never too early to start saving. Even though you might think like, I'm just starting my first job, like why do I already need to be saving for retirement? Like it's, especially like with the way the 401k works, like when you elect however much you want to be taken out of your paycheck, you make that decision up front and you see what comes in afterwards. So you're not really thinking about it after you make that decision, but you know that you are putting money away so that you don't need to think about it as much later on. So what I did, and obviously it's up to everyone individually and like what your like circumstances are and everything and how you're budgeting, but a lot of the employers will match like however much you elect to put in your 401k. So and at that point it's basically free money. So why not match the maximum, put in the maximum that they will match. So for example, like if they say they'll match your 6%, you can put in 6% and then you'll receive as much as you put in from them. So that's just kind of a good like general rule of thumb to go by. It's not like the perfect scenario and everyone can make like what works best for them. But that's a huge benefit, just being able to buy into that early so that accumulates over time and you can see how your money is growing. A lot of employers too will offer like a lot of other benefits, such as like, well, at least for me, since I was going for my CPA, the firms will offer like the Becker or the review books for reviewing for the CPA. So that's something I definitely took advantage of, just because that would have been very expensive investment on my own. So just kind of seeing what your company or firm offers and what works best for you. A lot of them will offer health insurance plans, and they'll all have places where they lay out like what they're offering. So when I first started, there was like a huge introduction and like bot that would walk you through exactly what your personal goals are and what your finances are, and kind of give you recommendations and offerings of what they offer. And then you could make like informed decisions from there. I think you're on mute.
Yeah. I'm cardinal sin. I just want to explain real quick as far as the 401k goes, just how important it is to start young. So can I share my screen? Yes, I can share my screen. Beautiful. So I want to show you all just real quick the effective compound interest for somebody at age 21, which I'm guessing a lot of you are, versus later on. Let me just show you this. So if we assume that you're 21 and you're going to retire when you're 70, and you can earn 8% on whatever you invest. If you earn, one second, if you invest $1, one second, if you invest $1, all right, at that 8% rate, and you have a compound over, in this case, it would be 49 years. So 70 minus 21. Don't worry about the algebra if you're not cool with it. So right now, if you just invest just $1, it's going to multiply itself 43 times. If instead you wait until you're 30, you've lost more than half of your value. Let that sink in for a second, because that's important. The first 9 years between age 21 and 30 matter as much to your retirement savings as the years 30 to 70. It's because of the way compound interest works. I could put up more schedules if you want, but you'll get bored. But just trust me. And then the other thing is, as Caroline said, if your employer matches, right, well, then all the better, because that $1 becomes $2. So then you really are doubling your muscle because you're taking advantage of what your firm offers. So be really savvy about whoever hires you. Ask lots of questions about their retirement options, because that right now, as a young person, honestly, you're probably, again, knock wood, I don't know your business, you're probably healthy. Health insurance may kind of fade into the background. We should talk about that too. But retirement is something that your youth provides an advantage that you will never get back. So do as much as you can to save for your retirement now, because again, you won't get this opportunity again. I'm gonna get off my soapbox and shut up now. But Caroline, another question. So just real quick about health insurance. I know a question that you and I talked about that I'm sure a lot of students have is about staying on your parents' plan if they have one, or going off. So can you tell me about your considerations there?
Yeah. So after looking, like there are a lot of offerings from like dental to health insurance. Like they pretty much offer everything that you could think of. A lot of times it is like more cost efficient to stay on your parents and like until I think you can be like 26 is the max that you have to switch off of your parents' plan. So that's what I personally decided to do, just because after looking at like what my parents have and what the firm offered, just where it was at now, it made more sense to stay. And obviously I'll revisit that as I move and as things change, if I don't know if I need other health benefits or anything. But that's the good thing too, is that they're also flexible. So you can, I think it depends on like your firm's like, or your company's like year and when you can elect to change your benefits, which they should lay out to you like once you're electing for the first time. But you can always change it. So really nothing is set in stone. That's what I decided to do now. And maybe I will wait till I'm 26 and I'm off my parents, or if I need to change it before that too, like that's totally possible. So that's at least what I decided to do. But definitely something to like keep into consideration when you're hired and you're looking into that.
I keep forgetting I'm muted. Real quick, I just want you to see, where am I? Dang it, where am I? Oh, okay. So I made a little fact sheet. There are just some things that I want you to understand about how health insurance works. So when you're trying to comparison shop, when you're trying to say, should I stay on my parents' plan or should I move off? It's not just about the cost, it's also about what you're getting for your money. So there are some terms real quick that I just want you to be familiar with. Over here, so premiums are essentially like club membership. It's what you got to pay every month. So you may want to compare. That's certainly one consideration. How much are my parents paying to keep me on their plan versus how much would I pay on my own? Then there are also co-pays. You may be familiar with this. If I need to buy prescription drugs or go see a doctor, how much do I pay? Maybe it's $25 or $50 or $100. That should also factor in. There's also a deductible. The deductible is how much you have to pay before health insurance kicks in. So you want that number to be low. So you may say, hey, if I stay on my own health insurance plan instead of being on my parents', I'll pay a little more, but the deductible is far lower. So the net cost is going to be better. There's also things like out-of-pocket max and co-insurance. There are plenty of online like resources that can help you understand all this stuff. But just in general, speak the language the same way that your salary itself shouldn't be the sole deciding factor in where to work. The cost of health insurance shouldn't be the sole deciding factor in whether to keep it, because you may be paying 10% more, but getting 100% better benefits. And that usually is going to be worth it. And again, I know this stuff is boring. This is how people get taken advantage of, is because they're like, oh, this is boring, I'm not going to look at this. Look, advocate for yourself, because nobody else is going to do that. Again, soapbox off, and I'm going to shut up. But what else? So we talked about planning ahead. So one more thing, Caroline, do you use auto pay?
I do not, just because I like it. I don't know. It kind of forces me to be more accountable, to go in and to see like exactly what, I don't know, what my expenses are and what I'm paying off. I mean, there are so many benefits to it, because then you don't need to think about like going in and paying every month. So I mean, there are pros and cons. I personally don't, but I mean, it's something I could look into. I don't right now though.
You have a very complimentary perspective to mine. See, I sometimes I'm like, just take it out. But you're right. So auto pay will make sure that you're not, delinquent as long as you've got enough money in the bank. But what Caroline says is certainly valid, that sometimes you want to take that personal interest and be like, wait a minute, what have I been spending money on? So that's a fair point. So there's benefits both. One other thing that I wanted to talk about, and I'll use my own story. I don't want to get into Caroline's business, but student loans, I got to figure, are going to be top of mind for at least some of you. And I just wanted to explain the very basics of how it works, because this is something else that if you choose not to look at it, it's something that's going to come back to bite you. And I don't know any of your business, but if you choose to ignore the burden of student loans that's been placed on you, and I say this with a lot of guilt on my shoulders, because I know that I get paid out of you borrowing money. So I figure the least thing I can do is help you repay that debt. But I want to show you the basics of how that works. So I built an amortization schedule. And that already sounds boring, but I want to show you the basics of how it works, so you know what options are available to you. So real quick, I usually use this to teach students about home ownership, but we're going to see that it's the same thing for student loans. So if you graduate, from Loyola with $60,000 in student loan debt, you're paying 5% interest. 10 years is the standard repayment plan length. It's called the standard fixed repayment plan. This means you'll be paying about $636 a month. And the way this works out is every month you're going to have some interest and some principal. As you pay, in other words, principal means you pay off some of the debt. So after that first month, you don't owe 60 grand anymore, you owe some less. But as time goes by, you see that the amount of interest you're paying off goes down, the amount of principal you're paying off goes up. And the reason why is because as you pay the debt off, interest has less room to grow. So by the time you're done, your last payment includes a laughably small $2.64 in interest. Now, I mention this because I want you to see how certain elements of this machine work. So we really can't do much about the principle itself. Let's assume that that's fixed, but things you can do. Notice here that as part of this deal, you're not only paying $640 a month, but you're also paying, in addition to the 60 grand you hypothetically borrowed, an extra 16,000 in interest. Now that doesn't sit right with me. That's a entry-level Honda right there. I'd prefer the car than to pay the interest and get nothing for it, right? So what can we do to make this better? One thing you can do is choose to cut the term. You can say, I'm going to pay over 5 years instead of 10. Now watch what happens to required monthly payments. They go up, but the interest goes down and you're done in half the time. Why? Because you're attacking the principal with a lot more dollars at the outset. The problem, of course, is that means I got to come up with $1,100 a month. Maybe I can't do that. So something else you can do is you can simply choose to pay more. And you can turn that on and off like a faucet. So I can say, hey, you know what? I'm going to kick in an extra $100 a month. Watch what happens then. I'm saving about 3 grand in total interest and over a year and a half in payments. Why? Because again, I'm shrinking that principal more quickly. This can go the other way too. If it turns out you graduate and this amount is not something you can handle right away, you can double the term. Now watch again what happens to required payments and to the total interest paid. This gives you some relief in the short term. You're paying a little bit less, but because the principal is shrinking so slowly, you end up paying more than double the amount in interest over the life of that loan. I mention this because I want you to be aware of your options, because I want you to know, again, that the muscle that you have here is knowledge, right? If you know how this stuff works. And by the way, does anybody want to take a shot? There's one number on here, and my former students should know this, but there's one number on here that you can shrink with nothing but upside for you. Which is the worst number on here, the enemy that you want to get as low as possible? I see I've lost your interest. It's the interest rate, my friends. Oh, wait a second. I got a private chat. Yes, private chat, you're right. And you got it in right before I said it. So you get full credit, extra credit. This is not an exam. But anyway, if I reduce the interest rate, watch what happens for just a single percentage point. I've saved about $4,000 and I've saved dozens of dollars a month. I cut it another point and wow, things keep getting better. The problem, of course, is that you can't just demand lower interest. What can you do? Right now, even before you started paying your student loans, what's something you can do to increase the likelihood that you'll get a lower interest rate? What can you start building?
Credit.
That's what I'm talking about. So, and let me show you how, even if you don't need it, just that maybe you're not a senior yet, I don't know. But in any case, one more thing I want to show you. And again, this is just, I get excited about this stuff. But anyway, so one last thing I want to show you is where credit scores are born. One second, why am I not able to? There we go. Okay. So here's how a credit score is made. 35% of it is payment history, meaning did you pay on time? 15% of it is the length of your credit history, meaning how far back do you go? If you start building credit by getting a low limit, no fee credit card now and paying it off regularly with extreme punctuality, you can start making yourself look better. So when it comes time, not only to pay off your student loans, but also to apply for a mortgage, or even earlier to apply to rent a place, to get a car loan, to get a better credit card later on, you've got a track record. I'm just saying there are favors you can do for yourself at relatively low risk that'll pay big dividends when it comes time later on. Because if you start worrying about credit only when the loans come due, you're not too late, but you're definitely later than you could have been. Anyway, Caroline, was there anything else that you wanted these young, bright minds to know about before we open it up to questions?
I guess just like going into it, knowing that your system of like organizing and how you're going to handle everything, like you're not expected to know right away, like how you're going to do it, just because it is very different from being in college. There's a lot more to manage, which shouldn't be stressful. I mean, it should be like an opportunity and you should be excited just because there are a lot of things that come with like graduating and being out there and managing everything on your own. Like there's always people you can like ask for help. So you that everyone that has like been doing this for a while, like kind of can give you like good advice. So like your parents and professors and anyone, like your friends. So there's always people that are wiser that like you can go to. Um, and I don't know, I guess just like nothing's going to be like perfect right away, but just kind of finding your system, I think is really, really important.